Hello and welcome to Marx Trading. Today we are going to be talking about candlesticks and quite frankly why we don't really like them for trading. Now, just going back to tell you a little about what Marx Trading does, we are predominantly trend followers. So if you are a day trader, there might be certain use cases where candlesticks do come into play where they can be a little more effective. But in terms of trend following and really riding a trend, we find them to be almost really useless for a number of reasons that we're going to go into. And in terms of trend following, what we do, we are looking for explosive, longer term trends that will get us 20, 30, 40, and even 50% gains over a 70 to 150 day period. So when we're talking about that long of a term of a period, to some investors that's long, some investors that's short, but for us, candlesticks are not that highly effective. So let's just talk about candlesticks first. All right, and as we mentioned, candlesticks do not provide good confirmation of signals, or what many will say, predictable alpha. All right, what are candlesticks? So candlesticks are the open, high, low, close. Now in terms of price series trading, and most shorter term traders are always going to look at price series, not so much fundamentals. Price series really is open, high, low, close. Now on moving averages, that might just be the close. Maybe it's just the open, that the way you calculate it. I do like open, high, low, close. It's much more effective and removes a lot of volatility because it's taking the average of the day. So that is a good thing that candles do, unlike just a regular closing price series. Now, if you're not familiar with candles, a green bar is up, red bar is down. Now, what you have in the middle is called the body. And the high point, you get this little, what we call a wick, is the very top. Now the top of the body, right here, is the close. The bottom of the body is the open, and the low part of the wick is the low for the day. Pretty self-explanatory, easy, and it's a nice visual. Let's take a look at the next slide. So this would be an example of a bullish candle, and this would be a bullish hammer candle. And why is that? Well, as we could see on the wick, that the wick is significantly lower. Let's just say this is at the end of the day, and the green part meant the stock closed up for the day, and it was significantly higher, and it rallied much higher from the low point, typically 2 to 3 times the size of the wick. So that would be considered a nice bullish hammer candle. All right, inversely, what would be a bearish inverted hammer? Well, obviously, as we could see here, it made a high that the wick came all the way down, and the body was much smaller and closed red. So in theory, what we're saying is that the price shot up and it was pretty decisive, and it didn't really try to close near the highs of the day. It closed pretty much near the lows of the day. Pretty easy stuff. All right, so what are the issues with a candlestick chart? Well, typically a 1 day, a 2 day, a 3 day, a 4 day trend is statistically irrelevant. We need relevance in terms of data. The more information that you have in terms of price series data will be more statistically relevant. That's why longer term trends are stronger in terms of relative strength. Markets are random day to day. That's why short-term periods are very hard to grade the trend strength. Now, candlesticks, typically, it's hard to start grading the strength manually and just looking at them over a couple day period. You need more than 5 days to really calculate the trend strength. And when you start doing that manually by eye with a candlestick, it's pretty daunting to go ahead and look at 500 different stocks. Also, there is no real forecasting. And when I say no forecasting, you can't forecast by looking at a candle over a day or two and saying, okay, we're going to get a significant breakout. Does this so-called signal provide a high level of confirmation? And the truth is, you can go back, which I have. I've back tested 500 stocks in the S&P going back 30 years. And there is no statistical relevance in terms of 30, 40 different candlestick patterns that are going to provide explosive moves greater than 50%. It's about 50-50 crapshoot. It's not a leading indicator. Okay? So that is the second part. Unlike mathematical research that's done by a lot of mathematicians, quantitative large hedge funds, research academic papers that have been done on trend following or momentum. There's a lot of papers out there. You can go to AQR. They have collected a research going back a couple hundred years on the momentum premium, why momentum keeps working, and trend following. The case study, I believe they have a case study of 100 years going back why trend following works. So if you love investing like we do and you want to educate yourself as much as possible, go ahead and Google AQR, momentum, and trend following. They've done a lot of white papers and research. Now, it is initially somewhat daunting and it might not be the most fun read initially, but it will give you real empirical evidence of why momentum and trend following do work. Okay, so next, what is momentum? Well, you have two types of momentum, really. And so you have momentum is going back and looking at a look back period. And most quants will look at a 12-month look back or a 6-month. Sometimes they'll blend both of them together. But for this case, a lot of quants will just look at the 12-month look back. And so if a stock has a positive return on the 12-month look back, that's saying it has positive momentum. And then what also you can look at is the relative strength. Nothing new. It's been around for a long time. We're not talking about the RSI index. We're talking about just relative strength. It's how strong is the momentum relative to its peers or another index. And so what we see here is the green line. Its relative momentum is weaker than the blue line. And when quants grade momentum on a relative strength basis, they're going to say, okay, what stock in that group has the greatest return on a 12-month look back? Okay, so the more data you have in terms of price series is going to confirm how strong that trend is. Okay, so here's the issue. This stock has already made a large portion of its move. That's the issue with technicals. It's after the fact. So it's already made this big move. How do we potentially get into a trade that's just starting to break out longer term? Well, we need a good trend following model that's going to allow us to see a signal that is just about to break out that has a higher probability of a medium term trend that can move 20, 30, 40, 50%. And the more data that we have, both short term and medium term, that's going to create a robust signal, and we'll talk about robust and confirmation of a signal later on, will allow us to capture and go long a specific stock before the larger move happens or that parabolic move happens in the trend following signal. So let's take a look real quickly at some examples in terms of the candlestick that I have seen in the past and why I think it's pretty subjective. Let's take a look at Apple, everyone's favorite stock here. And anybody who wants to for free can go to TradingView and just type in candlestick patterns. All right, so let's take a look here, and it's free. And I'm trying to maximize this. All right, so what we have here is a number of candlestick patterns, and we have one negative one, which this is a falling window candle, and that essentially almost caught the bottom of Apple in April. Then we had a bullish candle here, this pattern, which did nice. It did a good job. So we would have gotten long this name at around 66.70. And then we would have sold it at around, I don't know, let's say 71. But now we hit a bearish engulfing candle at around 71, and the stock went up to 78. So far we're at about a 50-50 confirmation level of how well this works. So we would have sold here, okay, 79, and boom, went to 75. Now, depending on your time frame, maybe that was a great trade. For me, I'm not looking to make 4 or 5% over a 5-day period. Again, we're looking for 20, 50% returns over 70 to 90 days. So we got out at this 79 level, and the stock proceeded to go all the way up to around 88. So that was a decent level. Then we had another engulfing pattern here, and we would have got out at 88. And then the stock rose again all the way up to about 100. And then we have a dark cloud cover at 100, and the stock got all the way down to about $89. Okay, not bad. But in the meantime, we just lost out on about 20% on 2 trades prior. After that pattern, the stock resumed off of its 2 standard deviations below its mean, and then we went all the way back up to 120. So we probably would have missed that to a certain degree unless you're going to buy that breakout. And then we had another bearish move again at about 125. Stock went up to 140, did a nice job here. The point is, if you keep going through this exercise, all you would have done is stressed out, chopped yourself up, and missed the longer term trend from $66 all the way up to this 127 level. Now, how do you ride that trend? Well, there's a number of ways. I mean, the easiest way to look at it, if you're not using anything proprietary, is quite frankly just default to a Renko chart with an overlay of a volatility stop, and that would have allowed you to take advantage. Let's see what time frame I'm looking at here. 1 day. And that would have allowed you to take this trade up very easily from $68 until you broke that level to 125. So there's much better ways to get involved in the market and ride the trends than getting whipsawed with candlesticks. Candlesticks, again, do not provide a high confirmation of high probability outcomes. They just don't. There's not enough data going back. Unless you're building out your own statistical models going back at least 30 days with candlesticks, it's very difficult. And one thing I will say with the Renko, the issue is it's after the fact. So you will miss a significant amount at the top when the stock hit 140 until it starts really breaking down to 122. That's why we like using our own proprietary models that will allow you to enter a trade and exit a trade using more so a proactive approach to getting in and out, not reactive after the fact. So what we have here is our own proprietary models, and the rating values here are showing the trend strength. And it does a very nice job, and it doesn't have a lot of momentum volatility built into the price. The red lines below is what we call the mean reversion or the counter trend model. More negative it becomes, more buyers are coming in, more sellers are stepping away. What we want to do is once it hits maximum velocity of an overbought level, we will remove exposure. But we will talk about that later in other videos. We hope you really enjoyed this one. Thank you, and see you soon.